Warren Buffett's second rule: a stock must have long-term prospects. As anyone who knows or has studied Warren Buffett will know, Warren buys stocks with the intention of never selling them. Now, this may not always be the case, as we have seen him sell large portions of some of his Berkshire Hathaway holdings, such as Delta Airlines recently. But his philosophy stays true. He never intends to sell a company once he buys it. Having said that, there are reasons behind why Warren Buffett does not like to sell, which are not purely due to his love of the companies, which I will get into later on. But how does Warren decide if a company or product will have long-term prospects? To determine this, we will have to ask ourselves, will this company or product still be relevant in 30 years? This may seem straightforward, but predicting the future is never a simple task. For this video, I will use 3 examples of stocks or goods which we can determine if there is lasting prospects for. Facebook, a social media giant with the majority market share in a multi-billion-dollar market. Not only this, but Facebook holds one of the top 10 market caps in the world right now. Knowing how diverse the company has been over the last 15 years, there is no doubt in its resilience to changing with the world. But can we guarantee it will still be as prolific in 15 years? It's hard to say with the changing world. This is not a no, but we cannot say for certain that it will still be around in 30 years. Kraft Heinz, another market leader, but this time in the food industry. Warren is a known admirer of this company and, to his ridicule, has bought a large portion of the company at a much higher market price than it is currently trading. Can we see a future in this stock? Of course. Food will always be necessary while humans are alive, and seeing as this brand has already acquired the Warren Buffett seal of approval, it is a yes for me. Philip Morris International, the tobacco industry, a sector which has been booming over the last 50 years and is seemingly recession-proof. With these positives, there are certainly drawdowns. The industry has become heavily regulated and taxed in more recent times. How is this industry outlook over the next 30 years? For me, it's not great. As a sector, there is a large distaste and a poor moral feeling towards its products. With such strict regulations, I cannot see it having a future. From these aforementioned examples, we can get a taste for what Warren Buffett may look for in his purchases, to align with his already impressive portfolio. But now, we should delve into why he chooses stocks which will be held over a lifetime, rather than companies which could be sold quickly for profit in a short space of time. This, simply put, is for tax reasons. By holding long-term positions in companies, Warren Buffett does not have to pay excessive capital gains tax on them. I will not get too deep into this topic for this video, as it is a tale for another day. That is all for the second part of Warren Buffett's rules to buying companies. Please stay tuned for part 3 of 4. Please like and subscribe and leave a comment with any questions you may have.